Welcome everybody. We're just starting on the live broadcast. Okay, thank you guys. How is it going? I am so happy to be back here. Um, Let me check something. Okay, I want to see if I'm also live. I always have this habit of having my phone also connected when I do my live stream. So there's really no rush. Um, Welcome, guys. Mostly on this account, we're talking about investment. We're really trying to encourage people to invest. Give me a few seconds. Uh, okay. So, welcome, guys. How are you doing? Yep. So, yeah, we're just starting right now. Let's have some fun. Yeah, we're just starting right now. Welcome to everybody. I've been saying welcome for like a minute, right? It's becoming annoying. If you're new here, my name is Z. I am the proprietor of this account. Uh, this account is mainly catered towards people that are interested in investing or people that want to know about investing, especially investing in stocks. We're going to be talking about things to do with investment, trading, the whole investment industry, okay? So, welcome to my live. If you're watching the live show right now, make sure that you give me a sub. Please kindly help me with a sub. Okay, if you've got enough time, please stay in the live room and share also. You can also assist or help by sharing, by liking, by commenting. Okay, so what do I have in store for you? I'm sure you guys can see the PPT that I have in front. That's in front of your screens. We're going to be talking about why you should invest in the stock market. So before we start, do I have anybody in the audience who's invested in the stock market? Do I have anybody in the audience or who's watching the live who has any experience with trading stocks or buying stocks or the stock market? If you are on the chat, please tell me, guys, just by typing yes or one. Yes, because it's also encouraging to touch on topics and subjects that other people probably who are watching might know about. I'm not saying that I am the guru or I know everything. I know some things, but this is just to create awareness, and also it's a way to boost this account because this account is pretty much new. That's why I also need you guys to what to like, share, and sub. Okay, so there we go. We are going in right now. So why should you invest in the stock market? I'm thinking right now, if you go on any platform, YouTube, where I am doing my live, you go on Instagram, you open anything nowadays, there is this push towards investment. There is this push. Okay, the algorithm is always flooding investment stuff, right? Yes, the algorithm is always pushing, is always flooding our screens, our phones, our computers with investment app. So yeah, this is another one of those, unfortunately. So why should you invest in the stock market? So traditionally investing in the stock market is one of the best tools, okay, to grow wealth in human history. So in the entirety of human history, from when human history began, or when acquiring wealth, the discipline of acquiring wealth began, investing in stocks has been one of the best tools to grow your wealth. Okay. Um, to escape poverty, to pass on some wealth to the upcoming generations, your children, to leave an inheritance. You cannot do all or accomplish all of those things without growing wealth. Okay, so growing wealth is really important. Growing our wealth is for everybody. It's not for a selected few. Okay, so there you go. It's historically proven that if you want to grow your wealth, you should involve yourself in the stock market. and many other investment vehicles that are there. We're talking about bonds. We are talking also about real estate. We're also talking about um, savings and many other things that we're going to get to. So the market has averaged a 10% annual return on investment historically. So there's more history here. Okay, the market has averaged a 10% annual return on investment. So historically, even till today, if you invest, there is a 10% return on investment. Okay, you invest $1,000 into an investment vehicle, you'll invest $10,000 into an investment vehicle or portfolio with stocks, then history says you're getting a 10% annual increase or value appreciation as your return on investment, as the benefit. Okay, because remember, we're investing to reap something. Okay, we have an expected outcome that we have, so we expect to get something after we have invested. Okay, so also savers are losers, the battle of inflation. Okay, battling inflation. Great stream, very informative. Thank you to MK Investing. Should be one of my friends in here. Thanks for that. Savers are losers, battle of inflation. We all know that having assets or investing in assets, okay, or investing in any kind of equity is a lot better than just having some cash that's sitting in a bank account. Yeah, I know some of you guys watching right now, you've got a lot of moolah. You got the bag in the bank account. Well, there's a better way to why allow your money to just sit there being idle when your money can bring in more money. Okay, this is what we're just trying to say over here. So what assets are greater than cash. Okay, so savers, if you're saving money, traditionally you're a loser. If you're investing, that means that you're a winner. Okay, you're losing purchasing power by not investing. Okay, by not investing, you are losing purchasing power. That's self-explanatory. We're also going to go about the fees, and because investing, there are some costs, there are some fees. Okay, zero trade dollars, zero trade fees are now the norm. Okay, are now the norm. So that you know why they have zero dollars for trading and for fees is because the reason is to allow people, is to make people more comfortable, is to make people have a more easier start when they begin to invest. It's to attract more people. Okay, so actually having low fees, low costs, low entry costs is actually beneficial if we want to have more and more people investing, or more and more people engaged in investment. So low expense ratio for solid investments. Okay, so there are some companies really there are really no barriers to entry. Okay, just buying a stock, there is a zero fee attached to that. Just trading for a stock or certain number of stocks, there's zero fees levied, or they are some inexpensive fees. Okay, it's not too exorbitant depending on the investment vehicle or the package that you want to invest in. And you do not have to be a genius. That is also the reason why we started this account. You do not have to be a genius. If you ask me, a few months ago, I was not a genius, but I just developed the interest, and I also had enough courage to just start reading at length about investing and watching a lot of material. And right now, I'm beginning to understand that, you know what, I am behind. But you do not have to be a genius for you to be able to grow your wealth or to invest. Okay, so right now we're going to move on to the next slide. Okay, what is a stock exactly? So a stock is a share of ownership in a company. That's all it is. A stock is a share of ownership in a company. So if you buy a stock today or tomorrow, or if you already own stocks like, let's say, Microsoft, McDonald's, Tesla, you are already a part owner of a company, okay, through the shares that you bought, through the stocks that you have in that company, okay. Think of each share being a slice of pizza, okay. The person with a lot of slices, the more slices you have, the more your ownership stake, okay. That is simply what stocks are. So buying shares gives you what? Gives you equity, gives you security. Buying shares gives you equity, security, stocks, which means ownership in shares of a company. So when you buy shares, when you buy stock, when you buy equity, when you buy security, you get what? Ownership in shares of a company. Okay. So for example, Microsoft, you can see there, guys. I usually like to use Microsoft in my examples. Also, Microsoft, we have shares outstanding. Okay, this is a valuation from not long ago. It's not the current one, but it's from not long ago. I believe the shares outstanding for Microsoft right now are over 7.5 billion. So we've got shares outstanding, and then we've got the share price. Okay, so imagine we have seven. It's valued at 7.56 billion. This is Microsoft. Okay, they are 7.56 billion shares, and the price per share per the publication that I used was $216. So now we want to measure, want to now see the market cap, the entire valuation. So market cap is basically your shares outstanding, the number of those shares multiplied by the share price. So we get a whopping market share of $1.633 trillion. So market share is a way of measuring companies, their valuation, how important, how big they are, how valuable they are. So we have this term called what? Market capitalization. So companies are typically measured by their market cap. Yes, market capitalization or market cap. So market cap changes over time because share prices and shares outstanding can change over time. Okay. That is what investment is all about. Investment is not static. Okay, investment is not static. There are market fluctuations. Okay, there are market fluctuations in once you come on the side of investing. Okay, so market cap is always changing. This valuation is always changing because shares outstanding are changing, and also share price is also always changing, maybe on even a daily basis. So buying and selling a company stock drives share price. Okay, so now we know what drives the share price is buying a company's stock. Yeah. So are we together right now, guys? Are you watching? Are you following? Okay. So let's move on to the next slide. Want to move on to the next slide. Give me a few minutes over here. I want to see if everything is good. Okay, make sure that you send a like. Make sure you give me a sub as well. Okay, so now let's move on to the next slide. Why do companies issue stocks? Okay, remember, it's not you who's issuing stock. These are companies that issue stocks. So why do companies issue stocks? Corporations issue stocks to raise money for their business. Okay, as we know, companies, billionaires, whatever company that you know that's out there, they're in the business of expanding their business operations, um, embarking on new projects, opening new branches, improving their research and development, and also improving their marketing and their advertisement. So corporations issue stock to raise money for their business. So when a corporation issues an IPO, basically they're announcing to members of the public that buy and come and invest in this company by buying a stake of this company. So when you purchase stocks, you're buying a stake, a ownership, a part of the company, and inevitably the money that you use to buy those shares, the company then uses that money to develop their business. Okay, raising money for their business. As you can see, I have listed a few of those reasons. Things like fund a new product line, okay, a new product line. Maybe it's a revolutionary product. It's just a new product line. You know, some companies have different product lines. Hotels are one of those that industry that will have, you will have multiple product lines under one brand. Same as car industry, same as many other industries. So maybe they want to fund a new product line, so they got to raise money by issuing stocks. Research and development, R&D. If you want to be ahead of the pack, then definitely you always got to be inside the lab. Okay, you always got to be researching, you always got to be reading deeper, reading farther, researching and getting new concepts, getting new ideas, always having improvements and the like. So R&D as well is where some of this funding, this money goes to fund R&D, invest in growth. Yes, growth on a number of scales. So you're just investing in the growth of the business or the company. Okay, this might be trying to enter new markets, you know, trying to enter new spheres and the likes like that. You do know some companies are limited to certain markets because of certain regulations, okay? But probably they want to enter new markets, okay? They want to enter new markets, so they have to invest in that market they want to enter into or they want to enter in. And the last one is simple: pay off debts, okay? Companies, you think you're the only person with debt? No, you're not the only one. Companies also have accrued debt. Okay, companies also accrue debt. Welcome to the world of business. Yes, companies can accrue debt, and sometimes they will need to offset that debt. So they gotta what? They gotta sell part of the ownership and get money to what? Offset some debts. Okay, so debt payments is the other reason as well. So now we're going to be talking about types of stock. We've got preferred stock and common stock. So generally, when you hear people talking about stock, they're talking about common stock. Okay, so right now I'm saying stock repeatedly over and over and over. So in the loose sense of the word, when you hear people talking about stocks, they're usually speaking of what? Common stocks. Okay, so we got what? We got preferred stocks and common stocks. Okay, so preferred stocks are another kind or another type of stock, and then common stocks are another kind and another type of stock. So with common stocks, you have voting rights. Okay, so if you, for example, you have some money and you go and invest in any company that called out an IPO or whatever big company that you want to buy some investment in, might be YouTube. Okay, and you are the common shareholder in that company or of that company, then you have voting rights. Voting rights just state that your voice, you can cast a vote, okay? Especially with issues such as electing the board, the representatives of the board of directors. Some of that responsibility to select those people falls onto common shareholders. So you've got voting rights. Okay, those are some of the benefits of you owning stock in a company. You get to vote, especially if you're a common shareholder. And also, what do you vote for? Or representatives of the board of directors. What do board of directors do? These are the people who what? They are sit down and make major decisions on your behalf. Okay, things like mergers, okay, things like acquisition, acquiring new companies, or merging with another company or a competitor to become a powerful force in the business world. Okay, so all those decisions, they gotta be made by somebody. Okay, and that somebody has got to be voted in power. So these are some of the benefits. These are some of the rights that are reserved to common shareholders. Okay, but also common shareholders, though, they are last in line to get paid out in case of liquidation. Okay, in case of liquidation, this business doesn't pan out, it doesn't work out, then your common shareholders are the last to get their investment back. Yeah, I'm laughing because I've been a common shareholder and I've lost money, but it's fine. Last to get paid the dividend. Okay, dividend is profit made when companies trade. Companies are trading on a daily basis. Some of them are reaping profits, and a dividend is a part of that profit that gets paid out to the stockholders as a form of thank you. And that dividend can be a good way, nice way to have passive income that just comes here and there. Okay, they can be paid quarterly or year in, year out, depending whether you are a common shareholder or a preferred shareholder, preferred stock shareholder. So it means that if common shareholders get paid last, who's getting paid first? In terms things go south. When things go south, who's getting paid? Obviously, it's preferred shareholders. Okay, you are usually buying common stock when buying stocks. Okay, so you're usually buying stocks when we're talking about common stock. So we're going to talk about cap. We also did talk about cap. Okay, let's go. So we're going to talk about how are stocks categorized. So stocks are not the same. They will never be the same. Okay, stocks are also different. So how are stocks categorized? This is important. So we've got large cap, mid cap, and small cap stocks. Remember, yes, large cap, mid cap, and small cap stocks. We did talk about market cap. Still remember market capitalization. So we've got large capitalization, mid capitalization, and small capitalization stocks. So we still have that formula. Market cap is shares outstanding multiplied by shared price. So large cap stocks or companies are valued at 10 billion plus. Okay, that's the market cap. If it's a large cap companies, it's 10 billion plus. Okay, so we are now talking about maybe your Johnson and Johnsons, we're talking about your Microsoft, we're talking about, you guys know a lot of these companies. Okay, the real established big boys. Okay, so typically hard to achieve massive growth due to size. Okay, yes, they're already big, so they're not going to get any bigger. Okay, there's not going to be massive growth. Okay, because these companies are mature. These companies are worldwide. We're not talking about your Coca-Cola. These companies are in each and every country and each and every culture. Okay, so they've matured. They're there. They're not going anywhere. Okay, so their aim is not really on growth. Their aim is really on to sustain the business, to keep it going. Okay, proven track record over many years, frequently offer dividends. Okay, so they have a proven track record over many years. So I did mention Coca-Cola, right? The Coca-Cola company has been around for a very long time. Okay, they're in every country, almost in every country. Yes, I'm sure in every country people take beverages, right? Okay, proven track record over many years, frequently offered dividends. Okay, so these are your large cap. And then we also have mid cap. These are a valuation between 2 to 10 billion market cap. They're not as large, not quite large enough. Okay, not quite large cap and more established, but they have a more established track record than the small cap companies. So often targets of M&A, mergers and acquisitions. So those large cap companies, if they want to expand or they want to absorb someone else, they usually target the mid cap. Okay, so mid cap are usually the target of mergers and acquisitions. So they're being acquired. So Mid caps are being acquired by what? By large cap. Mid cap are merging with what? With the large cap. Then we have small cap. That is the last category. This is like 300 million to around 2 billion market cap, typically younger, and are usually seeking aggressive growth. Okay, these are your companies that pop up every day. These what is the name? They call them these startups. Yeah, these are these startups that are typically younger and are seeking aggressive growth. Yes, so they really need a higher risk and don't usually offer dividends. So there's a higher risk because we're not really sure. They do not have any proven track record, so we're not really sure. So there is a higher risk. Okay, so for every entrant, if you're gonna enter or if you're gonna feel like you need to invest into this one, then there is a possibility of managing higher risk, and they don't usually offer dividend because look, they're still young, they're still small, they're still starting, so they are seeking aggressive growth so that they jump to maybe mid cap, and after a number of years, maybe a number after some generations or after some decades, they can also be classified as large cap. Okay, so there we go, large cap. Okay, how are stocks categorized? We'll talk about this one later. So this is a morning star box. It's got two X. It's got an X axis and a Y axis. So you can see there is large, mid, small, and there is growth, blend, and value. Okay, we'll talk about this on another day. Okay, now let's move on to this one. How are stocks? We're still continuing. So growth stocks, these are big potential for growth. Okay, growth stocks offer you big potential for growth, outpacing the market. So they have a lot of explosiveness to them. Okay, they offer a lot of growth and they have the ability or the potential to outpace the market, outpacing the market, like going far ahead of the competition or others. These are your Amazons, these are your Facebook, these are your Microsofts. Yeah, usually companies to do with tech, communications, and IT, usually these companies, okay? Typically low or no dividends, okay? So typically no or low dividends. These companies have matured, they've already grown. So usually they are reinventing, they are reinvesting returned earnings. So whatever they earn while trading, they're gonna what? They are gonna use that. They're gonna pump it back into the business. They're gonna reinvest that money back into the business. Okay, so typically maybe low or no dividends, but they're very valuable. Okay, they're very valuable to the extent that if you own a lot of stock in such a company, when you decide to sell, that stock has got a lot of value attached to it. You can get a lot of money out of it. Okay, so we have income stocks. Okay, but usually people are not people who are into growth stocks are already wealthy people. Okay, they're not lacking in some capacity, they're not lacking money or the means of survival to some capacity. Okay, these are rich people. Okay, so hence they do not need dividends or being paid out a profit because they've already made it in life. Okay, so usually, so we now have income stocks. So now this is a regular dividend payment. Okay, this is now for some of our people who would want to receive some income as a benefit or as a reward for their investment. Okay, so regular dividend payout. Okay, so we're talking about your Walmarts, your Verizons, and many other companies. So proven track record and business model, consistent increase in dividends. Okay, so the dividends, as the business grows, the dividend goes up. Okay, so these are income stocks, which a lot of people are actually trying to invest in income stocks. Okay, to get some sort of income when they do sell their investment at a higher valuation. Value stocks perceived to be trading below its fundamentals. Okay, value stocks, they are, okay. It's just a perception to be trading below its fundamentals. Okay, so typically seen as unfavorable in the marketplace. Yes, these are value stocks. They're just suspect. It's a matter of perception. It's a matter of the eye test. People just think, these ones are suspect. This might crash. I might lose my money. So typically seen as unfavorable. So, so they are judged according to the eye test, but it doesn't mean that in every case is the same. They always underperform. Sometimes they just need you to be a lot more patient with the investment. That all is required. So there we go. We did talk about growth stocks, income stocks, and value stocks. We also did talk about the um, the common stocks and the preferred stock as well. We did talk about market cap as a measure of how you know, companies are valued, okay, or companies are perceived. Okay, so there you go. Let's move on to stocks. So we're gonna just run down some of the sectors, the main 11 sectors or industries uh, where you could carry out your investment. Excuse me. So stock sectors, an area of the economy in which business share a product or service. Okay, there are 11 broad sectors. So we have 11 broad sectors, and we have at number one, we have oil energy. Okay, energy, we're now talking about your fuels, your oil, your gas, your coal, etc. We have a lot of people that invest in energy. Okay, energy is really important. Okay, and also we have materials. Okay, metallurgy, materials, we're talking about metals, we're talking about chemicals, we're talking about paper. Okay, we're now talking, and then third one is industrials. We're talking of your defense industries, your aerospace, like NASA, like yeah, going out of space. Okay, manufacturing. I do believe also Elon Musk should be what his company is in the aerospace industry as well. We do have consumer discretionary. We're now talking about what we wear, uh, apparel, household products, to see what we eat, consumer staples, food, beverages, etc. Healthcare, we're talking about pharmaceuticals and healthcare equipment, financials, the banking sector, and then we have the IT sector as well. We're talking about your internet industry, your software and semiconductor, telecommunications, utilities, and real estate. Okay, so these are the 11 core industries of or stock sectors. Okay, so right now we've discovered that. Is anybody watching right now? Okay. We've started understanding risk. What is risk? The chance that your actual outcome will differ from your expected income outcome. So when we go and invest, there is an actual outcome, and then there is the what expected. Usually when we invest, we have an expected outcome. We've already seen it in our mind, but it may not go as planned. Okay, it may not come out, okay, as we've envisioned it. Okay, so that is what we call risk, the chance that your actual outcome will differ from your expected outcome. So your expected outcome, your actual outcome, the actual outcome may exceed the expected outcome. That's a good, right? And the actual outcome may underperform as well, may exceed or it may recede. Okay, uh, there you go. So yeah, that is what we call risk. Risk includes the chance of losing some or all of your investment. So that's what risk is all about. There can be losses. Remember, it's investment. You might lose your money. You might lose your investment. Okay. Risk should be reward, in a sense, should be the reward that you receive for what? For attempting to invest. Okay. For taking on that, for carrying out that action. Okay, as investors, we are compensated for the level of risk we assume. Okay, so you can't expect somebody who's invested in two stocks to get rewarded at the level that someone who's invested in a lot of stocks, like let's say 20,000 or 50,000. The risk is different. Okay, the risk is different. Okay, the outcomes are different because of the magnitude of our investment. But risks may include losing some or all of your investments. So people invest wisely. We're also going to have investing, that is investing in a startup versus investing a savings account, right? Okay. Understanding risks. So we've got 7 risks types. We've got market risks. This covers the economy, developments, and other events. So market risk, we can just talk about the 2008 economic meltdown. This was economic developments and the rest of the market. It was happening to everybody, okay, regardless of whatever market or sector you're in. So there's the market risk. Yes, compounded by economic developments and many other events. We also have liquidity risk. Can't sell your investment. You buy something, you invest in something, but can you sell it off? Okay, can you sell it off? Is it a worthy or a worthwhile investment? Okay, that attracts what? That attracts liquidity. That attracts money. Okay, I imagine having a barn in the middle of, a barn in the middle of a cornfield that is in an inaccessible place, and you're trying to sell it, okay, and no one is buying it because number one, maybe the location is not good. So yeah, you end up being stuck with your investment. You can't sell it, okay? So that could also lead to losses in a sense. So we also have concentration risks. Too many eggs in one basket. It's always advised that you spread out your investment in a diversified portfolio to spread risk across. So we also have credit risk. Entity can't repay. The company or the corporation that you're an investor in uh, owe its creditors, okay? Owe its creditors some money, okay? So they are in debt, okay, and they can't repay that loan. So inevitably, you might end up losing. You might end up losing your investment if the company liquidates because of failure to pay off their loan. Okay, something like that. Then inflation risk, loss of purchasing power, or rising risk. Your investment time frame may change. Okay, based on depending on certain things that may happen. Okay, so foreign investment risk applies to foreign investment. So yeah, foreign investment risk applies to foreign investments. Welcome, welcome, welcome. Okay, let's just run down quickly. Okay, individual types of stocks or equities. We have individual stocks, mutual funds, index funds, exchange traded funds, and REITs. Okay, that's real estate. Okay, investment trusts. Okay, so usually here we're talking about stocks. Okay, but later on we will delve much into what mutual funds are, index funds, exchange traded funds, and REITs. Okay, so let's just move on. Types of stocks, equities, what to buy. So I got a little diagram there, the corner there. You can see you got lots of companies in there. We've got Shell, Netflix, MasterCard, Exxon, Visa, Google, Walmart, Netflix, Nestle, Intel, Microsoft, Coca-Cola, IBM, Toyota, Amazon. Who did I leave? Johnson and Johnson, AT&T. Oh, so many companies, right? Mm-hmm. Yeah. So type of stock, equities. So we got individual stocks, like we just talked about. reduced no fees. So if you're going to deal with individual stocks, there may be reduced fees or no fees at all. One of the pros as well is no management fee to own. So you do not have to fork out some management money to manage that. Okay, someone else is taking care of the investment for you, and you get to manage your stock as well. You get to monitor it. Okay, complete control, understanding of what you own. Okay, so you have complete control, okay, of your investment. Taxes are easy to manage, capital gain and loss. But the cons are hard to diversify. You need 20 to 100 to achieve adequate diversification. More effort, more time to monitor portfolio. We're not talking about rebalancing. And we also got to talk about emotions. Yeah, individual stocks, you invest your emotions, so much of your emotions into it because you are in charge of it. Okay, you haven't assigned it to a broker or anybody like that. And FOMO. Okay, mutual funds. These are pools of money from the public to buy securities. Okay. Number one, they're liquid, they're diverse, professional management, and lots of options. You can have balance, they can come in a fixed income, money markets, income, etc. Cons are higher fees, okay? Higher trading fees, not FDIC insured, large cash holdings, or they involve people holding onto a lot of cash, okay, and hard to evaluate in terms of apples to apples. Mhm. Now let's move on to the next. So we now have index funds. This is another investment vehicle, another form of investment. It's called index funds. Basket of stocks to mimic a certain market index. Okay. It also has low fees, outperform active management over time, easy to own, manage, invest in, achieve your goals. Okay, so easy to own, easy to manage, easy to investment in, and you will achieve your goals. So the cons are no control over holdings. So definitely, yep. Lack of downside protection, not like a hedge fund with an actual hedge to protect it. Lack of different strategies, okay? Lack of different strategies. Yep, lack of different strategies. There you go. Now we're going to talk about what? ETFs. ETFs just means it's a basket of stocks to mimic a certain market sector that trades on an exchange. Okay. Access to many stocks. Those are the pros. Low expertise ratios, easy to earn, manage, invest, achieve goals. They also do have their con side, actively managed by ETFs, have higher fees, lack of downside protection, diversification is limited by focusing on one industry. Now, real estate. Real estate, okay? Real estate. You guys make sure that you follow, make sure that you share, okay? Make sure you follow and share. Okay, so rates, guys, we're talking about what real estate investment trust. Again, that's what rates mean. A company that owns, operates, or finances income producing real estate. That's what rates mean. Access to a historically unaccessible asset class. They are very liquid, stable cash flow through dividends. So you get to get some dividends out of your rates. You have to pay out 90% of income. Historically sound asset class. So this is one of those asset classes that when you become an investor or you decide to become an investor in this asset class, it has some high returns. Okay, it has some high returns. It's sound. Okay, it's not as volatile as other asset classes. So rates there. Your cons, dividends are taxed as regular income. Okay, yes, dividend. They also tax dividends, and you understand sometimes tax may be high. Subject to market risk, economy downturn in 2008 can have high management fees. So we're going to talk about some financial statements. We do have a few of them. Let's see how many. We'll get into not quite a lot. We're just going to be talking in passing. So we got a lot of them. hmm Okay, now moving on. How to evaluate a company. So if you're coming in right now, guys, please help me with a sub. Make sure that you share, make sure that you like. If you have any questions to drop, please drop in the comments. Let's chit chat, let's talk investment. Let's make some money. Let's go. Financial ratios when buying stocks. Where do these numbers come from though? Balance sheets. Where do these numbers come from? Okay, balance sheet, snapshot of financials. So you got assets equals to liabilities plus shareholders' equity. Okay, we also have what we call the income statement, revenues and expenses during a specific period. Net income, total revenue, and gains, total expenditure minus total revenue plus gains minus total expenditure plus losses. Okay, cash flow statement, cash inflows and cash outflows. Okay, and how do you get your, where do you look? You look at your operations. That's where you get your cash flow statement, business activities, etc., investing, property, plant, and equipment, and financing cash flow between a business and creditors 10K. There you go. Are you guys following? Okay, we're just left with a few minutes and we'll end this one. Usually we're doing it for an hour. Okay, some days we do the live stream, some days we are doing some things else. But you guys will get something. Thank you. So yes, guys, feel free to drop your comments in the chat. I want to feel your excitement. Okay, I'm just curious as to how you guys are feeling about this information. Okay. Okay, let's go. So now what? How to evaluate a company, financial ratios when buying stocks. Okay, so you have to consider some financial ratios when you want what? When buying stocks. Okay, you're gonna have to um, valuation. Look at valuation, profitability, liquidity, debt, solvency, and efficiency. Okay, so those are some of the items that you can you know look at when buying stocks. Okay, so valuation, profitability, liquidity, debt solvency, and efficiency. Okay, how to evaluate a company? So price to earnings ratio. Okay, it's what we call PE ratio, the price to earnings. Okay, price to earnings ratio. It's a valuation ratio. So PE ratio is equal to company share price to its EPS. Okay, relative value of a company's shares, apples to apples. That's the formula. Market value per share, EPS. Okay, I was supposed to do live examples here, but yes, we do have a board. Next time we'll really do some um, live examples. Okay, healthy price to earnings ratio is 15 or lower. If A price to earnings ratio is above 15. It's like around 30, 25. It has to be 15 and lower to be considered healthy. Okay, let me stretch a bit. Price earnings to grow ratio. This is a valuation ratio. Remember, we are talking about these five metrics: valuation, profitability, liquidity, debt, and the likes. So we did talk about valuation now. Now we're talking about the other one, okay? Price to earnings, price to earnings to growth ratio, valuation ratio. Price to earnings growth ratio is company's share price to its EPS growth, relative value of company stock value factoring in growth. And that is the formula, okay? And this is an estimate, and also healthy PEG ratio is 1 or lower. Price to book ratio, valuation ratio, PB ratio, company's market cap to its book value, compares the cost of the stock to the value of its equity the company was sold today. Stock to assets value, okay? Value of equity if the company was sold today. Formula: market price per share, value, book value per share. So right now here, guys, we now have a lot of calculations, a lot of calculus. Yeah, these are things that you will have to also um, tackle. Do investment requires although it's financial literacy, it also requires a degree of, working out formulas, being analytical, being sharp, just having an awareness of what's happening to your investment. So all of these now are just some calculations. Maybe we can do it on the board another day. And yeah, so that was just an introduction for you guys, that if you haven't thought about investment or about stocks, we did talk about a lot of things. Um, so I'm sure you guys did touch or did grab something that you might find very, 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 very useful. Mhm. Exactly. So we have reached the end of our live broadcast. If you guys have any questions, please feel free to ask. Okay, please feel free to ask. And if there's anything you didn't understand, please leave a comment. Write in the comments. Okay, and I will respond to you in real time. Okay, guys, there we go. So if you guys want this PPT, please feel free to reach out, and we can also send you this PPT. But basically, in a nutshell, that is what investing in stocks is all about. We did talk about market cap. We also spoke of the sectors as well. We also talked of those risks, those 7 risks. We also talked about common shareholders and and preferred shareholders and their roles. We also did speak on um, we spoke on large cap, we spoke on low cap, we spoke on mid cap, and also we talked about growth stocks, income stocks, and value stocks. And we did discuss the differences between all those types of stock. Okay, so our day ends here. Yeah, our day kind of ends here. So I will be seeing you guys another time. I don't know tomorrow whether I will do a live show or not. But if I don't do the live stream, guys, I will have some content on this YouTube channel. So please kindly follow, give us a sub, and we will see you on the next live broadcast. Thank you so much, YouTube. Give us a sub, guys. Goodbye. Okay.